Imagine throwing, like, the party of the decade. You rent out a sprawling estate, hire a Michelin-starred chef. The weather is absolutely perfect.
Sounds like a great setup. But let me guess, something goes wrong.
Well, the guests eat, they drink, they dance, and when the night is over, Wall Street looks you dead in the eye and says, "This is a disaster. You should have hired two chefs and brought in a private jet."
I mean, that counterintuitive, almost surreal reaction is exactly what we're seeing in the global markets today, Tuesday, July 2026. Record-breaking corporate profits are somehow being treated as massive financial failures.
Welcome to Financial Candy. We're exploring the underlying mechanics, the weird incentives, and, the consumer impacts driving the modern economy. So what is the central mission of this edition?
We're looking at a systemic buckle under the weight of expectation. The top-line numbers look spectacular, but the actual mechanics of sustaining those numbers, the physical and financial infrastructure, they're reaching a breaking point.
So businesses and consumers are undergoing this profound recalibration in how they access what they need. We're calling it the modern cost of access.
Exactly. That includes the multi-billion-dollar ceiling hitting artificial intelligence infrastructure, the geopolitical price war over hardware, and the quiet, mathematically punishing ways financial friction is squeezing everyday households.
Let's start with the party host who just got told their catering wasn't good enough. Samsung Electronics just released their preliminary second quarter earnings, and operating profit hit roughly 89.4 trillion won. That translates to about 58.4 billion US dollars, which is an 1,800% year-over-year jump.
It's a historic quarter by any traditional metric. I mean, sales more than doubled. Yet market data showed their shares immediately dropped to nearly 7%.
And that plunge dragged down the broader South Korean Kospi index by 5%. Wall Street saw an 1,800% profit increase and collectively hit the sell button. Why the panic?
Well, if you look past the current quarter, it seems investors aren't looking at the money Samsung just made. They're calculating the terrifying cost of what Samsung has to spend next just to keep the cycle going. We're witnessing CapEx, or capital expenditure, exhaustion.
So the physical memory chips required to run massive artificial intelligence systems have become incredibly difficult and, well, expensive to manufacture. Samsung is charging a premium for them, which drove up their profits.
Right. But those surging prices are now severely hurting the profit margins of their biggest clients. The market is realizing there is a ceiling to how much companies like Microsoft are willing to spend on infrastructure before the economics just stop making sense.
It's like selling shovels in a gold rush, but the shovels have gotten so expensive that the miners are looking for cheaper tools and, the shovel makers' unions are demanding a cut. We're already seeing reports that Microsoft is doing exactly this.
Yes, they are fundamentally shifting their strategy for office products like Excel and Outlook. They're replacing highly capable, incredibly expensive external models from OpenAI and Anthropic with cheaper, smaller internal models. Because they figured out that you don't need a massive, compute-heavy supercomputer just to draft a polite email or format a spreadsheet.
And that pivot signals a broader market panic. If the era of the blank check budget for AI memory is over, the companies supplying the hardware are suddenly vulnerable. Plus, Samsung is facing massive internal friction.
Right. They recently had to scrap a 1,000% base salary bonus cap and dedicate 10.5% of their operating profit to labor unions just to resolve weeks of protests.
At the same time, they're pouring billions of dollars into building brand new semiconductor fabrication plants in southern South Korea from scratch. And building a fab means acquiring land, securing massive water and power resources, and buying lithography machines that cost hundreds of millions of dollars each. It takes years before a single chip rolls off the line to generate revenue. So institutional money sees all that, the shrinking client budgets, the rising labor costs, the massive construction bills, and they pull their capital.
But the retail investor side of the market is behaving entirely differently.
Oh, completely. I'm looking at the semiconductor space, and while the VanEck Semiconductor ETF saw a 5% sell-off heavily weighted with puts, NVIDIA is telling a bizarrely optimistic story. Options traders just bought $11 million in premium on NVIDIA 200 strike calls expiring in late July.
Which is fascinating. But before we move on, let's break down that trading floor jargon for us. What does an $11 million premium on a 200 strike call actually mean for the everyday listener?
When institutional traders buy puts, they are purchasing a contract that gives them the right to sell a stock at a specific price. So they profit if the stock price falls. It's a financial safety net or a direct bet on a decline. A call option is the exact opposite.
It's a bet that the price will rise. So a 200-strike call means the trader is buying the right to purchase NVIDIA stock at $200 a share. By spending $11 million in premium, which is the non-refundable fee you pay to buy those contracts, retail traders are making a massive, highly leveraged gamble.
They're betting that NVIDIA stock is going to rocket past $200 before the end of July. They are completely ignoring institutional anxiety as well as recent industry rumors about manufacturing delays for NVIDIA's next-generation server racks.
And you also have shifting gravity within the institutional side itself. A massive amount of capital is currently being sucked out of the broader market to fund SK Hynix's $28 billion ADR listing happening this week.
For anyone unfamiliar, an ADR is an American depository receipt. It's essentially a certificate issued by a U.S. bank that represents shares in a foreign stock. It allows American investors to buy a South Korean company like SK Hynix without dealing with currency conversions or foreign exchanges.
So institutional cash is being hoarded for this massive new listing, while retail traders are throwing millions at short-term NVIDIA options, hoping for a lottery ticket. The contrast is stark.
But the most vital thread here is the friction of physical hardware. If the software and memory components required to run modern AI are hitting a financial ceiling, we have to look at how companies are affording the physical bodies that house these digital brains, the robotics, the autonomous vehicles, the smart infrastructure.
That transition is crucial. If a tech giant like Microsoft is flinching at the cost of software models, a logistics company trying to deploy a fleet of autonomous trucks must be suffocating. The market response to that hardware bottleneck is ruthless price destruction, spearheaded by state-subsidized companies.
Take Hesai, a Shanghai-based manufacturer that is currently dominating the global autonomous vehicle ecosystem. Their sensors are embedded in Amazon's Zoox robotaxis, agriculture machinery, and even the passenger flow monitors at JFK Airport.
And Hesai slashed the cost of a LiDAR sensor, which is the component that lets machines map their surroundings in 3D, from over $10,000 a unit down to under $200. We have to unpack the mechanism behind that price collapse because it reveals a profound market distortion.
Right. Hesai didn't suddenly invent a manufacturing process that is 50 times more efficient than their Western competitors. Official corporate filings from 2025 show they utilized a 15% preferential corporate tax rate, secured below benchmark borrowing from state-affiliated banks, and utilized a 200% research and development tax deduction.
Let me stop you there because the mechanics of a 200% R&D deduction are wild. It means for every dollar Hesai spends on research, they get to deduct $2 from their taxable income. The government is essentially paying them to iterate and dominate the market.
But knowing all of this, it raises a massive question. Are U.S. commercial companies willingly buying heavily subsidized foreign technology with obvious geopolitical baggage just to survive their own hardware costs?
They are, because the alternative is being priced out of the autonomous market entirely. However, this cheap access introduces severe vulnerabilities. In 2024, the U.S. Department of Defense blacklisted Hesai, designating them a military-civil fusion risk.
Which means the lines between a company's commercial technology and a foreign military's intelligence apparatus are basically indistinguishable. When a U.S. company mounts a $200 LiDAR sensor on a truck, they're installing a device capable of mapping U.S. infrastructure with millimeter precision.
And the vulnerability goes far beyond geopolitical surveillance. It hits basic functional safety. LiDAR works by firing millions of laser pulses every second and measuring how long they take to bounce back, creating a 3D digital map called point cloud data.
Researchers at Duke University demonstrated a terrifying cybersecurity flaw. They proved that malware can manipulate a LiDAR's point cloud data to inject phantom pedestrians.
A hacker can literally make an autonomous car slam on its brakes by projecting a person who isn't there. Or worse, erase a real physical object from the car's vision entirely. And you don't even need a sophisticated hacker to trigger a catastrophic failure.
The underlying code of cheap hardware can be incredibly brittle. Like on February 29, 2024, a simple leap year coding error in a firmware update temporarily shut down Hesai sensors entirely. The devices simply bricked themselves because the calendar had an extra day.
When you combine the cybersecurity vulnerabilities, the geopolitical risk, and the basic software fragility, you begin to understand why the enterprise market is flat out refusing to purchase this hardware outright.
Which brings us to the explosion of ROAS, or robotics as a service. Buyers are terrified of being stuck with obsolete, bug-ridden, multi-$1,000 paperweights, so they've stopped buying and started renting.
Hospitals are a perfect example. Many are deploying Moxie, a 4-foot-tall robot with heart-shaped LED eyes that navigates corridors to deliver medical supplies. The hospital does not pay the massive upfront capital expenditure to own Moxie. They pay a monthly subscription.
So the robotics company handles the maintenance, pushes the firmware upgrades, and operates a remote command center to physically pilot the machine out of the way if it gets stuck in a hallway. The risk of ownership is entirely offloaded back onto the manufacturer.
We're seeing this same financial model aggressively pitched for consumer homes. A company called 1X is rolling out the NEO Home Helper robot. If a consumer wants to buy the NEO outright, the price tag is $20,000.
Almost no one will do that. Instead, the company offers a subscription model for $499 a month. The massive capital cost of accessing futuristic technology is being amortized to look and feel exactly like a standard utility bill.
Speaking of accessing what you need without a massive upfront capital expense, you can find financial candy, brain candy, and classic audiobooks seamlessly over at clarineratio.com.
Transitioning from the macroeconomics of robotics and AI budgets, we have to look at how this overarching theme of financial friction lands directly on the household balance sheet.
Because the geopolitical tensions dictating corporate supply chains are simultaneously dictating the basic cost of human survival. Following the recent Iran conflict, the closure of the Strait of Hormuz, a crucial waterway handling a fifth of global energy supplies, pushed crude oil back over $70 a barrel.
An energy shock at that level instantly transmits inflation into local markets, altering the cost of access to shelter and warmth. Look at the direct human impact in the United Kingdom.
According to the Bank of England's latest figures, 1 million more homeowners are facing significantly higher mortgage bills. For a typical owner-occupier rolling off a fixed-rate mortgage over the next 2 years, they face an increase of roughly £45 a month, which is about $60.
But for the 750,000 homeowners who locked in sub-3% interest rates years ago and are rolling off those deals right now, the math is brutal. They face an average increase of £170 per month in repayments.
Simultaneously, Northern Ireland supplier Budget Energy is hiking residential electricity prices by 9.5% in August, adding roughly £122 a year to a typical household bill.
When macroinflation tightens household budgets, the way institutions interact with consumers often transforms from supportive to actively punitive.
The UK student loan crisis really illustrates how institutional framing disguises structural financial friction. A decade ago, government presentations pitched Plan 2 student loans to teenagers by comparing the monthly repayments to a simple £30 a month mobile phone contract.
I have to play devil's advocate for a second. I mean, a loan is a legally binding document. Didn't these students sign the paperwork knowing the interest rates and the terms? Why is a £30 comparison so deceptive?
The deception lies in the mathematical mechanics of inflation and frozen thresholds. With a phone contract, you pay a flat fee, and the balance eventually reaches zero. The Plan 2 student loans carry an interest rate of 6.2%, but the repayment structure acts like a tax.
The government froze the repayment threshold at £29,385 until the year 2030. Graduates pay 9% of any earnings above that line.
As inflation pushes up nominal wages, meaning the number on the paycheck goes up, even if purchasing power stays flat, graduates cross that frozen threshold much faster.
So the government is capturing 9% of their artificially inflated wages. But because the principal loan balance is so high, the monthly payments rarely cover the 6.2% compounding interest.
The debt grows larger every single month, despite the graduate paying more of their income toward it. Framing a compounding liability designed to trap inflated wages as a fixed utility bill is a masterclass in financial friction.
And we see that same structural hostility extending into basic banking and retail behavior. The UK financial regulator recently discovered that major banks are actively pushing vulnerable and homeless individuals away from basic free bank accounts.
These specific accounts were designed for financial inclusion, meaning they don't offer an overdraft facility. Because there is no overdraft, there are no penalty fees. And because there are no fees, the accounts do not generate profit.
So branch managers create artificial friction, steering vulnerable people toward digital apps that are completely unsuitable for their needs, simply to avoid opening a profitless account. The physical friction of retail banking is being abandoned entirely.
The British department store John Lewis is cutting 200 jobs and closing 30 of its in-store money exchange bureaus. They're moving basic services like gift wrap to the checkout tills. They argue that consumers increasingly rely on digital payments abroad, so maintaining physical cash exchanges is an unnecessary operational cost.
Institutions are aggressively stripping away any service that doesn't generate an immediate digital yield. Which brings us to the bizarre contradiction in how consumer risk is currently regulated.
The new UK gambling regulations force operators to run strict credit reference checks on anyone spending over £1,000 in a 24-hour window, and that threshold drops to just £750 for bettors under 25.
The gambling industry is warning that introducing this friction will drive a large portion of the 22.5 million adults who place bets straight into the unregulated black market. The irony is staggering.
It exposes a fundamental redesign of risk across the economy. High street banks will actively deploy bureaucratic hurdles to prevent a vulnerable person from opening a safe, basic account to deposit their wages. Yet by law, the betting app on that same person's phone is now required to act as a rigorous financial risk assessor before accepting a wager.
Whether we're looking at Microsoft refusing to absorb the cost of external AI models, a hospital renting a robotic assistant to avoid obsolescence, or a university graduate realizing their education debt is a compounding trap, the underlying pattern is identical.
Corporations and governments are successfully utilizing subscription models, dynamic pricing, and regulatory friction to offload the risk of ownership and the burden of inflation directly onto the end user.
The cost of access is no longer a one-time transaction, it's a permanent toll booth. As our physical and digital infrastructure moves entirely to a rental model, from the robotic arms moving medical supplies to the software we need to draft an email, we have to ask ourselves a serious question.
Who actually owns the underlying assets of the future economy?
And more importantly, what happens to the rest of us when the landlord decides it is time to raise the rent? Keep questioning the numbers, and we will see you next time.